Good morning and a warm welcome to Colliers webinar. We have a packed agenda today and we have quite a lot to get through. I'd like to obviously introduce the agenda now, which is coming up. With regards to the agenda today, we have an occupier market undertaken by myself and Andrea Ferranti, which includes investment market. We then also have our speakers today, which is Rosso, Andrea Ferranti, John Webber, Head of Rating. John has over 35 years experience and runs one of the largest rating teams in the UK. We have James Pay, who's recently joined us, and his background is in the construction industry. We have Jessica Middleton-Pugh moderating today from React News. Thank you for joining us, Jessica. And then we have Ian Henderson, who has over 20 years experience in the property industry, previously working at Wincanton for over 10 years, and has now recently joined Associated British Reports as Head of Property. I'll now hand you over to Andrea Ferranti to start the market update.
Thank you very much, Len. And sorry, I think my fingers slipped there. I started flicking through the slides right at the beginning. So hi, everyone. Before we start going through the slides, I just want to warn you that you're about to see some eye-watering numbers. And the world record will be mentioned quite a lot in today's presentation. So without any further ado, let's now look at some of the key figures of today's presentation. So in terms of occupier activity in 2021, we saw a new record take-up of 50.7 million square foot, a record low supply of 18.1 million square foot, and the rental growth of all industrial of 8.7%, which is the highest since September 1990. Yes. So the investment market actually followed suit in 2021 with a record level of invested money, £16.7 billion. And this strong demand for investment assets actually took the UK net initial yield to circa 3.5%, which is a compression of a 65 basis point year on year, and drove total returns to reach the highest level since October 1989 at 37% actually. So, but what's the real driver of demand? I'm sure you will all agree it's the growth of online sales primarily. So online sales share of total in November 2021 came in at 30.1%. November data usually carries a strong seasonal effect. So it is worth mentioning that in November 2019, so pre-pandemic, this level actually reached a share of only 21.6%. Tomorrow, the ONS will be releasing the December data, so we'll be able actually to see what happened in 2021 as a whole. But given what we saw all the way to November 2021, we estimate an annual share between 27% and 29%. In 2020, this was 28.1%. So it could be very close to the record level that we saw last year, or slightly higher. We shall see. But the key message here that consumer shopping habits are being altered for good, in our view. So we briefly discussed the record take-up activity, but now let's look at this in much more details. Here you're seeing our usual bar charts looking at take-up activity by quality. So the market witnessed two consecutive record take-ups in 2020 and 2021, with the latter being 50.7 million, as we just mentioned, which is 3.6% higher on 2020. So flight to prime is a key theme of the market, as efficiency savings and ESG requirements are increasingly driving boardroom decisions here. So this is actually clearly reflecting to the statistics, as you can see these two lines, which are actually showing the share of take-up for design and build, which is purpose-built units, and speculatively developed units when compared to total take-up activity. So due to the uptick in spec development, we saw a share of take-up for purpose-built units reaching the lowest level since 2014, which is at 35%, as occupiers are actually racing to secure space in an extremely depleted supply environment. And conversely, take-up for spec space, again, has reached a new level of 31%, which is the highest since 2011. So with regards to 2022, I mean, we don't see demand changing much. It's still extremely robust. There are lots of deals under offer, big requirements happening. And again, we've seen already very strong activity over the first 20 days of the year. But on this note, Len, is there anything that you'd like to add? What's your view for 2022 as well?
Thanks, Andrea. I think a few observations. I think the first one is obviously D&B is normally around 45 to 50% of the total market. As you said, it's down to around just above 35%. The spec is above 30%, which is increasing year on year. It wouldn't surprise me next year the two merge together around 35%, as it is more challenging to undertake D&Bs at the moment. The other thing to say is out of that 50 million square feet take up, that was comprised of 144 units. No surprise, the size bracket between 100 to 200,000 square feet, there was 112 units taken. And I'm pleased to say in the larger bracket, 400,000 square feet, that's up as well, with 31 units being taken in excess of 400,000 square feet. We'll talk more about the supply and demand dynamic coming up, but I think it's about right at the moment. And if anything, it's struggling to get enough supply into the market to keep up with demand. Back to you, Andrea.
Thank you very much, Len. Actually, very impressive. You seem to know the numbers better than me, to be honest. And let's now look at demand by business type. I mean, unsurprisingly, I mean, demand is being driven by pure online players. I mean, we'll go through these figures in much more details, but actually the share of pure online players reached a new record again of take up 43%. This is actually up from the 33% that we saw in 2020. Third-party logistic providers also been extremely acquisitive and recorded a share of just shy of 26%, which is relatively in line with what we saw last year. But the key data here to analyze, apart from, of course, the huge growth of demand from pure online players, is the general retail. So it actually accounted for only 11% share, which is down from 18% year on year. I think these two figures are actually reflecting the transformation that our sector is going through, with huge demand coming from online players and online demand for deliveries, while general retail, of course, because of the pandemic, struggling a little bit. But more interestingly, if you analyze Amazon activity, which is not shown in this slide, but just want to give you a couple of figures here. Amazon take up accounted for 28.3% overall take up in the UK in 2021. This is up from 25% that we saw in 2020. However, in 2021, it wasn't only Amazon taking space in terms of pure online player demand, as circa 14% of total space was acquired by other online players such as JD.com, Boohoo, and Buy Direct, just to mention a few. If we move on to the supply side here, we can clearly see that the industrial sector is running out of space. Here on the left-hand side, you're shown with supply by grade. I mean, our Q4 availability figures are actually showing only 18.1 million square foot of space, which is down 34% year on year. I should actually point out that our availability figures also include space they schedule for completion in 2022. So again, it's a very challenging environment for occupiers to secure a space now. But developers, of course, are trying to capitalize on this buoyant demand and very low supply. And the market saw the delivery of just over 11 million square foot of space in 2021. But circa 75% of this space has either let or is under offer. Plus, all of the space that is completed in 2022, in Q1 2022, is already accounted for the supply figures. So we see again the market being very well balanced. In 2022, of course, we've seen a huge uptick in spec development, but I have to stress that most of this space is not currently under construction. However, it's marketed for completion by the end of 2022. So quite a few units will slip onto 2023. Some units are also still awaiting to start construction and potentially get detailed planning permission. But so it's a build and an estimate for 2022. And so Len, what's your view on this one? Do you think the market is going to be oversupplied by the beginning of 2023 when all this space is actually becoming available?
Thanks, Andrea. No, I don't. I mean, you've said already that there could be some challenges for this space, which is due to be delivered for 2022. The reality is it may slip into 2023. Already, if you look at this space, out of that 18 million square feet, which is due to be delivered, some of it's not even built, but 2.5 million square feet of that space has been let already. Our view is that actually it's barely keeping up with demand, the spec which has been delivered. I mean, if you look at that, the space of 18 million square feet, that actually breaks down to around 78 units by our calculation. So if you break that back down to an average, there's a unit size of 232,000 square feet. So I'd say the supply and demand dynamic is perfect at the moment. If anything, it's still on the light side for the supply to keep up with demand. So I would say still a very good dynamic, but struggling to keep up with the demand. Back to you, Andrea.
Thank you very much, Len. So if we move on to actually analyze rental growth, I got some interesting figures here. Here we're looking at average rents as reported by the MSCI. So the market saw a dramatic rental growth, again, relatively to historical standard. This is actually the largest increase, as we mentioned initially at this presentation, is the largest increase since September 1990 for UK industrial. Of course, London assets are outperforming. So I'm not going to dwell much on these numbers because you can clearly see the fantastic performance that the sector has delivered. Len, again, is there anything just you want to add here? Because of course, we're looking at average rent. What about the prime end of the market?
Thanks, Andrea. As you say, you're looking at the average there, which still shows good rental growth. But if you look at it from a prime perspective, I would say it's stellar, the rental growth. I mean, in London, you're looking around 25% for prime London rental growth for prime. And if you go to the regions, you're talking between 11 to 16% growth for prime accommodation. I think the other thing to say is obviously we've got colleague John on the webinar today. And he's going to talk more about the challenges which will come to occupiers, because obviously with the growing rents, that will obviously impact on the rates. But John will talk about that shortly. Back to you, Andrea.
Thanks, Len. Yeah, definitely with the strong rental growth that we've seen since the late rates revaluation. But John, we're looking forward to hearing more from you, John, later. But now the time has come to actually look at capital market here. So if we move on to the next slide, I mean, this chart says it all, to be honest. I mean, the market has recorded new record investment volumes of £16.7 billion. And these figures are still provisional because we're still clarifying and investigating deals, and property data, of course, is where the data is coming from, still collecting data for the end of 2021. But the strong demand is primarily driven, of course, by the strong rental growth. You got also strong rental growth prospects. I mean, still a lot good rental growth coming through, which needs to be recorded. Of course, capital growth and the subsequent yield compression. But one key data point I'd like to highlight, of course, is actually the strong uptick of investment activity share over total investment set in the UK. So it actually reached 29% this year, which is the highest on record. Again, signifying that some funds and investors are adjusting their allocations and, of course, increasing their weighting towards industrial. But how does this translate in terms of yield compression? So here you're seeing yields have nosedived. Here you're shown with a net initial yield as reported by the MSCI across these different subsegments, and yields are historic low. So the sector saw an annual net initial yield compression for UK industrial as a whole of 65 basis points to 3.6% net initial yield. London and Southeast assets, of course, are seeing the sharpest yields, with national distribution warehouses as in UK as a whole, witnessing actually the strongest annual yield compression of 100 basis points to 3.8% net initial yield. So distribution warehouses are outperforming in terms of yield compression. And this is, again, a clear signal of the increased demand for speedy deliveries. But let's move on to my last slide here, and let's look at total returns. So we're seeing, again, eye-watering numbers here. I mean, total returns will reach level of around 43.5% for London assets. Distribution warehouses here coming second as a whole, 40.4%, and standard industrial 37.3%. Just to clarify here, when we're looking at London, outer southeast, inner southeast, here we're looking at standard industrial as reported by the MSCI, but standard industrial also includes, of course, B8 uses, so distribution warehouses as well. But again, when we actually slice and dice the data, focusing more on distribution warehouses and only B8 uses, here we get these fantastic numbers at about 40.4% total return. So I'm sure investor developers have been quite happy with these figures, and we believe that the market will continue to deliver strong total returns. And as I previously mentioned, again, we will see a little bit more yield compression coming through the first 6 months of 2022. Then, of course, we shall see how the market will perform, also given the 3 rate rises which potentially are expected in 2022 from the Bank of England. But we shall see how this will develop. Given we're expecting, again, strong rental growth, the equivalent yields will remain, again, under pressure, even if we see the increased cost of money increasing. So on this note, I'd like to hand you to John Webber, who's going to discuss what's happening on the rating front.
Thanks, Andrea. Well, good morning, everybody. I think I've been set up here actually because I'm afraid I'm going to be the one who's going to pour cold water on all of the good news that you've been hearing so far in terms of returns and rental growth. I think the main issue is apparent to everybody. The government, as I'm sure most people on this call will appreciate, the government at the moment through the Valuation Office Agency and in Scotland through the assessors are currently undertaking a revaluation. The last revaluation, which is the current 2017 rating list, had a valuation date of the 1st of April 2015. The valuation date for the next revaluation in 2023, which comes live next April, a year in April, the valuation date is April 2021 in England and Wales, and it's actually 2022 for Scotland. So what we're looking at is a level of growth that will have taken place over that 6-year period or 7-year period in Scotland. And clearly, just looking at the last 12 months, there's some eye-watering figures in there. But what the government will be doing, and this is where I think there's going to be some bad news coming down the road, is the reality is that the government still needs 26 gross figure of about £30 billion every year from business rates. And unfortunately, for your sector, the reality is that the other one of the other main sectors, retail, will see a massive decrease in the values over that period, and they will be looking quite closely at your sector to actually make up the difference. And I think that's why there will probably be an aggressive approach by the valuation office in looking at the values that they will put in. Now, those values will not be known about until the end of December, early January of next year, and then the bills will be produced shortly thereafter. But I think if you look at the numbers in terms of the rental growth, we are expecting some pretty high increases, and certainly on average across the country, we're looking at around about 25–30%, probably as a minimum. Now that will mask clearly lots of different changes. So you'll have a situation where clearly, London and the southeast will probably have some pretty eye-watering increases, and you can see from those charts there. But those numbers are made up of a basket of evidence. So there'll be some figures which are higher than that, and clearly there'll be ones which will be lower. Now, what I would say is that, clearly probably everybody on this call has their own rating advisors. And there are two things I think they need to look at. One is in terms of making sure that the 2017 rating list figure is as low as possible. As an example, we had a reduction that came through this morning on a 1 million square foot shed in the Midlands that we're acting on, and that reduction will go back to 2017. That's quite important because that will start to affect potentially the liability from next year. So it's really about making sure your 2017 figures are as low as possible, because whatever happens, you're going to see some big increases coming through, and they're going to look very similar to those figures there. Now, the rateable value, which mirrors the rental value increase over that 6 or 7 year period in Scotland, that is only one part of the equation. And there are two other parts of the equation that you will all know on your rates bill. One is what the multiplier will be, the uniform business rate, and the other part of the equation is will there be any transitional relief? Will there be any caps on these increases? Now, on the 2017 list in England, there was a transitional scheme. Quite honestly, I would not budget for a transitional scheme this time around in terms of capping these increases, because they're going to have to give big increases to retailers, and I'm afraid the sector that's going to be paying for it is your sector. So if your rateable value is going to go up by 40% or 50%, then the likelihood is that the cap will certainly be at that level, if not higher, even if there is a cap. So if your rateable value is going up by that amount, then I think that's what's coming down the road. The other part is the multiplier. Now, we think the government politically will try and keep the multiplier at or around 50p in the pound. So you're probably going to be back to pretty much where you are at the moment on that multiplier. So that is where you're coming to. I think the other things that your sector needs to be aware of, there will be a consultation this year on online sales tax. And again, the online sales tax is probably going to target many of the people who are taking these new units, as already Len and Andrea have talked about. That could mean, again, an additional burden on those people who are occupying that space. The consultation has not been issued, but it will be issued this year. So they will be looking to extract even more tax from this sector. But I think it's really about, the government through the Valuation Office Agency, through the assessors. Quite honestly, they're going to be in a rush to get these figures. They're probably going to get some of these figures wrong. That means they might undercook some. They certainly might overinflate a number of them. But the reality is that you need proper advisors to look at these deals. There are a number of sale and leaseback transactions that have gone through with some eye-watering rents. The VO, left to their own devices, as well as the assessors, will look at some of that evidence and start to use that as a basis on which to value some of the units in your sector, and that's what you need to be careful of. I think in terms of the upside to all of this, there probably doesn't sound like there is much of an upside, but I think what you will see, this next list, the 23 rating list, is only supposed to be 3 years long. There'll be another reval in 2026. I think there will start to be a rebalancing of the whole market. I think retail will come back. I think that will certainly help, your sector going forward. But certainly from next year onwards, I would certainly build into your numbers, if you are the person who's liable for the business rates on your sector, I would certainly be factoring in some bigger increases. One of the things that we do look at Colliers through our rating team is looking at discretionary relief on under occupation, and sometimes that means under occupation in a cubic rather than just a floor plate context, and we've certainly had success at that. And that can be not that a unit is half empty, but it might mean the seasonal use of certain premises allows you to do that, and we have people in our team who do that. So listen, I don't want to pour too much cold water on it because there's lots of good news around, but guys and girls, I think you just need to factor in some increase in liabilities from next April, from a year this April. So on that note, I'll hand you back to Jessica.
Hello everyone, and thank you very much, John. So yeah, I'm Jessica Middleton-Pugh. I'm actually the residential and retail correspondent at React News, but these are two patches increasingly converging with industrial. As Andrea's touched on, we've seen e-commerce tenants really drive up rents and occupancy, and I'm sure as many of you may have experienced, but we're increasingly seeing industrial and residential investors square up against each other in the bidding wars for sites. So it's certainly interesting times, and seeing a lot of cross-specialism in industrial and logistics, as this panel demonstrates. So thank you very much, guys, for joining us. Want to welcome again Ian Henderson at Associated British Ports, James Pay, Colliers Head of Sustainability, and welcoming back Len and Andrea. And of course, we're not going to do all of the hard work. Keep your ears peeled, audience, as we've got a couple of polling questions coming up so we can hear from you too. So I just want to bat the first couple of questions back to pick up on the themes, Andrea and Len, you've talked about. So overall, rising rents in the industrial sector, obviously eye-watering figures, as you've said, but you know, this is obviously a good thing on the investment side, but do we see potentially these rising rents presenting a barrier to entry in terms of the tenant kind of profile coming in, and also potentially a challenge in terms of the size of the units, that, you know, many occupiers might want something a little bit smaller and the rent's more manageable, but is that actually in the development pipeline? Andrea or Len, if you want to pick that up.
Thanks, Jessica. If I start, Andrea, and then please chip in if you've got anything to say. I think, of course, it is going to be an issue for occupiers because they've sort of grown at such pace that to try and have on a warehouse or a logistics facility a sort of 25 or 40% increase on your rent is obviously going to have an impact on your business. You need to manage it very carefully. And I do think looking at your supply chain, which is Ian's background from Wincanton, people are going to look at that very carefully, and they're going to scrutinise their supply chain and then feel, should they actually have one or two big DCs, or should they have one DC and then some satellite operations around the key sort of conurbations such as London, Manchester, Leeds, etc., Edinburgh, Glasgow. So I think it's going to be a balancing act for the occupiers. But yes, Jessica, I feel it is going to be a challenge with these rents as they continue to rise.
Yes, Len, definitely, I agree. I mean, very quickly, so I'm not going to take up much time. I mean, what we're seeing in some cases occupiers becoming less, or rather than being forced to become less location sensitive. Although location is key for them, of course, they want to retain and attract labor force. So sometime also because of ESG requirements and trying to increase efficiency savings, they might want to, of course, opt for a better quality warehouses. But of course, sometimes they can't really afford a grade A or excellent BREEAM warehouse where they currently are. So sometimes they might have to opt for alternative locations.
Interesting, thank you. Well, let's bring in the first polling question, actually. Let's see what you guys think, because this is around what we think next year will be like. So the market has seen 2 consecutive record years of take-up. What level would you expect take-up to reach this year? You can only choose one. So you're going to hit a new record, or anything between 50 million to below 30 million square foot. let's see if the picture is optimistic. I know every time I do an industrial event, I end up asking, is this the top of the market finally for industrial? So yes, if you're able to show the results, that would be great. Brilliant. So it's nice to see optimistic. Looks like absolutely no one said below 30 million square foot. So that's very encouraging. Hopefully a new record or up to 50 million. Len, would you agree? Is this trajectory continuing, or is there anything on the landscape other than, obviously we've touched on rating challenges, that you think might kind of dull the optimism a little bit, before I open up the conversation to the other panelists?
Other than what we spoke about, Jess, I don't see anything. Obviously, e-commerce is going to continue to dominate and move forward. But, there are one or two challenges, the tax we're talking about on e-retailers, and also what John's spoken about. It just means it's going to give them a little food for thought. But in the round, the supply is not really keeping up with the demand. So we feel it's going to keep going. And if you look for top of the market, I'm going to say, it's always good to say a timeline rather than just fudge it. So I'm going to top of the market 2 years.
Great, thank you, Len. Lending your colours to the mast there. So now opening the discussion up, bringing in Ian. So, obviously all of this, these industrial dynamics are happening at a time when supply chains are being disrupted, as we know, by the pandemic and various demands for shipments. But, what's keeping you awake at night with this picture? I'm sure probably a myriad of issues. If you could talk us through them, please.
Thanks, Jessica. Morning, everyone. I think it's interesting around the supply chain, because everybody talks about resilience, and I've thought a lot about that. What does that actually mean in reality? Because people throw it around as a word, but what does it mean? And it feels, it's people, without a doubt. It's access to people and retention of people. So location of sites is going to be absolutely key. And that brings in another interesting point is, if you can't get the people, do you have to move the property to the people? Is it going to slightly change the dynamic in terms of where the hot spots of property development are? Question mark. I don't know, but I know it is an absolutely key issue. Power, which I'm sure you'll come on to, sustainability is key, and access to power. And then property. Property in terms of flexibility around property, future-proofing property, getting the absolute most out of your property portfolio.
Is this a point of tension, kind of coming back to the question I put to Andrea and Len, if rising rents are creating a potential barrier to entry and tenants are having to think a bit more innovatively about location, do you see a tension there between, as you say, staff are some of the most important resources a company can have, but are where the staff are, where the rent is most affordable? Presumably there's a bit of a crunch point potentially happening there.
Yeah, and it's another word people throw around, which is collaboration. And again, it's a buzzword, but again, what does it actually mean? And you sort of feel everybody has a responsibility to building in resilience. So it's as much on customers. My background at Wincanton, we were driven by contracts that were 3 to 5 years. So we were polar opposite, from a tenant's perspective, what we were looking at was polar opposite to what a landlord was looking for, which was length of term and certainty and everything like that. So, the interesting question to the customers is, can we extend the contracts? Can you extend that relationship between the customer and the 3PL, from 3 to 5 years to 10 years? So you can actually put down roots. You get, again, people talk about automation, in 3 to 5 years, you can't do that. In 10 years, you can put down roots. And you really have got this two-tier market. You do have, the companies like Amazon who can take 15, 20 years, put in automation, future-proof the building, put down roots. But there is a whole other part of the market, which is 3PL, contract-driven, customer-driven requirements. And it's important to get both. And now, being a landlord, from my perspective, that's what we've got to focus on.
Mm-hmm. Thank you. And challenging at a time when we seem to have an attention span of about 3 minutes to start talking to people about 20-year leases.
Well, sorry, Jessica, just
No,
to
no.
say those words, and I'm part of this because I'm a chartered surveyor. You know, our backdrop is Landlord and Tenant Act and our put-only reviews, and you know, again, at the moment, more than ever, it's about agility, being able to adapt the buildings, adapt to the market, adapt to the market dynamics. And, you know, as a property community, we have to support that.
Absolutely, thank you. And I think that point on agility is an interesting time to bring in James. So head of sustainability at Colliers. Obviously, anything we're now talking about to do with future proofing, 10 years, 20 years, 50 years, a lot of that is around the green agenda. So, you know, can you give a little update in terms of what are landlords and tenants needing to be aware of in terms of legislation coming down the track, and also how you see that connecting to this whole agility conversation we're having? Because, you know, a lot of changes and that might look different in 10, 20 years time.
Yeah, there's definitely a huge amount of change coming along at the moment. I think Ian mentioned that sort of two-tier, and I think it's two-tier in terms of how people are responding to sustainability as well. There's those that are really driving change, and then there are those that are desperately trying to keep up with the legislation as it changes. There's obviously the sort of background legislation that everyone hopefully is aware of around EPCs and the minimum energy efficiency standards. So from 2023, all current leases have to be E or above, and then at 2030 they need to be B or above. But in the background of that as well, the government last year released their new heating building strategy. The future building standard is expected to come in 2025, which will dramatically alter how buildings need to be designed and operated throughout the 2020s, looking at fabric, how they're heated and cooled. And so you mentioned the power is obviously key. Part of the sustainability agenda, which I think particularly around net zero, people forget, is that we need to actually reduce the energy we're using. It's not just good enough to turn it into electric and buy green power. We need to actually reduce that amount to make sure there's enough in the grid for one, but also ensure that there is enough green energy, which is where that push to on-site renewables, particularly industrial, can come in.
And how much is, you know, a lot of this legislation coming through, and just the general conversation around this future proofing, you know, how much is that being put on the shoulders of the landlords as their responsibility, and how much are tenants going to be contributing to it? Because obviously we're seeing things like green clauses in leases, which is very much becoming a tenant's responsibility.
From a landlord point of view, I think that the legislation that falls to them is that EPC legislation. However, and Ian again touched on the word collaboration, I think increasingly that will have to be something that's pushed, because occupiers are setting their own 2030 targets, 2050 targets. Landlords are also setting their own targets, but without working together, it's going to be very difficult to meet those. So it's definitely a collaboration issue. So yeah, green leases are really moving from just sort of clauses where you must not affect the EPC, you must not damage sort of fabric of the building, that kind of thing, to actually what can be put in place. So we both are working towards those ultimate goals that we are telling our shareholders, our customers, our employees that we're going for.
And Ian, what are you incorporating in your sites in terms of, you know, sustainability? We talked about power being very important, because obviously you have space around ports. You can't just easily kind of relocate that port if that site's not working, and you have to really think about what that's going to provide for clients for decades to come.
No, and again, it's interesting with the sustainability, because I've seen it before where things are implemented, but they've got to be practical as well. And the great thing with ABP is, what I've seen in the short time I've been there, there's been so many initiatives, but they're practical initiatives that work. You know, we've got a new cruise terminal in Southampton, which has got over 12,000 solar panels on it. We've got electric pool cars. You know, there's been £17 million spent on the rail connectivity at Southampton. 35% of the containers that go through Southampton go by rail, and we want to get that up to half. You know, by the end of the year, we're shooting for all electric use by ABP within Southampton to be generated by ourselves. And also we've got, you know, people don't realise ABP have 40 acres of land in Hams Hall, which is rail connected. So, you know, there are so many things going on, but what I'm seeing at ABP is that it's the practical application of them. And again, at Wincanton, I saw that, you know, it's so challenging because the building itself often doesn't use that much power. It does if it's chill or if there's automation in there, but there's a lot that don't have that. And the challenge is more around the vehicles, far more around the vehicles, and it's squaring that circle around, you know, in terms of getting the maximum load out of the truck, getting the maximum distance around out of the truck. And again, it comes back to that collaboration. Do you start to see sort of you know, points linkage across the country to enable those electric vehicles to come through sooner?
Very interesting, thank you. And John, bringing you back in if I can, there's actually an interesting shared point in this Venn diagram between rating and the proper, you know, full use of the sites, the units that are available, and that kind of sustainability conversation. I know when we were chatting this through yesterday, we touched on times where people were potentially cautious about, you know, partially using a vacant building in case it impacted their rating bill. And presumably as we move to using as much space as we can in these supply constrained times, that kind of conversation and flexibility is going to be very important.
Yeah, thanks, Jessica. Yeah, I mean, I think the ability to go to a billing authority and seek discretionary relief if there is underutilization is an interesting one that actually I think is not used as widely as it should be, and often it's just the nuances of the legislation. But you know, if you take a, let's say, take a national retailer, and I'm sure there are people on this call who we've actually done this for. If you look at a throughput of a warehouse facility, it's the warehouse manager who has the data to prove that that property is not 100% used at at any point in time. And if you can construct an argument as to why that is the case, you don't have to convince the valuation officer that the value needs to be apportioned. It's the rating inspector at the local authority, and some of them are actually quite sympathetic to occupiers of this space. So there's certainly the opportunity to look at that. The other side of it, on the green side, there's also a consultation out at the moment talking about the sort of excluding green improvements to buildings and being exempt from business rates. I think that will help a little bit. I think there's a little bit, if I'm going to be honest, I think there's a little bit of window dressing, because, you know, I think it's just saying, well, if you're going to put solar panels, if you're going to put some green energy there, you don't want to be necessarily hit, you know, for those as a disincentive. But the reality is, you know, on all these big sheds, the biggest value is in the price per square foot, and that's always going to come back to hit you.
Thank you, John. Len, bringing you back in. So as you guys touched at the start, you know, the highest rent for industrial properties in 31 years, which is, you know, amazing. But does this mean, especially tapping into this whole sustainability conversation, occupiers presumably want a lot of bang for their buck? Like, what are you seeing that they want to see from the units that they're taking for the next 5, 10, potentially 20 years, as we touched on earlier?
Thanks, Jessica. The most important one, I think, actually, is the ESG credentials, because obviously they're all trying to hit their targets. And going forward, I think the units of the highest quality with the best ESG credentials are going to win out for the occupiers. The other issue, of course, is there's such a lack of supply, particularly if you go to the larger conurbations, such as the major cities, particularly London. There's just very little availability of any grade A stock, which obviously is hampering occupiers' choice. And by not having a choice of only looking at one building, the landlord inevitably, particularly in London, may have 2 or 3 occupiers looking at it. So unfortunately for the occupier, there is commercial tension. And because there is commercial tension, then this is driving the rents up as well. But what I would say, get back to the ESG credentials. I think if it's got the highest ESG credentials, occupiers are finding that of the most benefit to them going forward, because obviously this is what's coming down the line, the tube, as it were, and they need to address this.
Interesting, and I think it'll be interesting to see which parts of the occupier kind of market are willing to pay for that, because obviously a lot of the fast fashion guys have been hit recently with accusations of greenwashing. So I'm sure we'll see as the years evolve as to who's actually putting their hand in the pocket for proper ESG kind of valid spaces. But on that note, let's have the next polling question, which is on this theme, please. So how will the EPC changes in 2023 and 2030 impact the capital market? Are we going to start seeing the disposal of spaces aggressively this year? And I think, you know, this is an interesting theme that I'm going to come on to you, James, in a moment. So how possible it is to redevelop assets, or whether investors are going to sit on them, or are we going to see loads of new space put on the market? So if you could put in the results when you've got them, please, that would be great. So yeah, interesting. So where possible, they will redevelop assets themselves. More than half of the audience think that, which is great and very interesting. I mean, so James, kind of picking up on this, how possible is it for a lot of the stock that you're aware of to retrofit into some of these requirements, or are we going to see proper ground up development? Obviously, we've got different energy sources, the power challenge that we've touched upon. That's a pretty wholesale redevelopment required, really.
Yeah, I think there's definitely, particularly looking at this new legislation, future building strategy, looks at the fabrics of the building, reducing that energy efficiency. So that will involve sort of major redevelopment potentially. But I think industrial does have that opportunity for retrofit. It has space on the roof, it has space around it potentially. So you can look at, you know, ground source, air source heat pumps, which do require more space and perhaps are more difficult to install into office scenarios. And obviously the heating cooling requirements are different. The other benefit for refurbing in, and if it is possible in industrial, is key, is that embodied carbon side of things, which is often forgotten about. So ground up development uses a huge amount of new material, which all has a carbon factor to it. By, you know, recladding, reusing structures, you can save up to 50% of that sort of built-in carbon that sort of often gets forgotten when you're just looking at that operational sort of energy use overall, is how that I guess that story is told to those eventual occupiers and the benefits to them, because it may still be easier. And potentially with you know, the VAT rules around new build versus refurb, there's still sort of some benefits outside of ESG reasons to starting again.
Thank you. And, you know, Ian, this is obviously more than just ticking the boxes in terms of, you know, the legislative stick that's coming down the track. I think collaboration has been kind of your word of the day for this. How do you see this as a landlord, as a massive landlord with presumably a development pipeline and a rolling refurbishment strategy? How do you see all of this kind of sustainability agenda in terms of you delivering quality, future-proof space to your tenants?
Yeah, and it's Andrea, and what we have to remember is a minimum. So it's, you know, we should be shooting for more, because, you know, it's the right thing to do. And I completely agree with Len, you know, customers, tenants will gravitate towards those, as they should. It's interesting with ABP because we've got a development program, which is port centric manufacturing program, which, you know, we've released over 20 sites across the port portfolio, which we're going to build out, and there will be more to come. So it's a massively exciting time, but it's different with the port in a great way, that, you know, it will be a tenant, but they'll hopefully be a customer, they're a neighbour, you know, we will be sitting next to them, and that's where that collaboration point comes in massively, because we have a vested interest. As somebody said to me the other day, you know, we are the custodian of the port, you know, we'll be there long into the future. So what we build, the people we put in, you know, it's got to be the right building, it's got to be the right customer, the right relationship. So it's a really exciting time.
And, you know, I think hopefully we're seeing more of a landscape for innovation and more spaces coming through. I mean, what are you seeing, Len, in terms of different types of units? You know, where are my triple story warehouses? I want to see more of those. What are we looking in order to finally release the bottleneck of lack of supply?
So do we, Jess. I mean, we'd love to see a multi-story unit. We've been talking about it for long periods of time. If I'm being honest, I personally only think it works in very high sort of density areas or conurbations. So, for example, London, you know, within sort of up to zone 3 possibly. And then if you go to ports and airports, they're the only locations I still see a multi-storey facility working. And I think it is a little bit disappointing as an industry that we haven't come forward with one as yet. There's been lots of talk about it for the last 4 or 5 years, but there still hasn't been anyone who's actually built one and completed one which has been put up to let. I do think it's coming down the line, and I think it's going to be the next sort of stage of the logistics sector moving forward. So like you, I'm very excited when it does happen, but still yet to see one being completed.
Do you think you'd be capable of doing a triple-storey warehouse, Ian?
I hope so. You know, we should be aiming for things like that. And I think, to Len's point, that, you know, if it's designed, and this is the benefit because I've been the tenant and the customer, you know, if it's designed properly, people will take it. You know, so make sure, you know, the routes up to the upper levels are wide enough so that if a lorry breaks down, you know, people can still get round. Make sure they're heated. Make sure there's not so it's all practical stuff, not too many pillars. You know, in my time at Wincanton, there was every customer requirement was different, so there was not one standard, you know, attribute of a unit. So as long as it's designed properly, you know, people will come. But I think it's bigger than that. It's the, you know, I suppose as an industry we've got to be bolder, because there's that which is the headline bit, but then there's out of town retail. You know, the potential, so, you know, sites are struggling. How do we repurpose those buildings? We talk about last mile, but where is the last mile now? You know, okay, we're supposed to be going back into the offices, but it's changed. It's going to be different for quite a while. Does that last mile become more spread out across the UK? You know, what are those buildings that aren't being used at the moment that could potentially be repurposed to build in that resilience we talked about?
Absolutely. And James, you know, looking at all of these various requirements from a sustainability perspective, has there been any impact, or would you see any risk in terms of that slowing down what is already a bit of a challenge in terms of, you know, speed of delivery of units to really satisfy demand? Because presumably a lot of developers could look at it and go, it's more complicated than ever to actually develop an industrial site.
Yeah, I think definitely that risk. I think to make it really effective, it needs to be an overarching strategy right from the beginning, built into everything you do. Needs to be effective. As Ian mentioned, you need to be looking further ahead than the current legislation as well, because otherwise you risk building something that is out of date by 2030, for instance, and risk running sort of repeat work. So I think the sustainability community particularly can be better at talking about it to other people. We're quite good at creating new phrases, you know, net carbon zero. What does it actually mean? How do we make it simple, and how do we make it, again, as Ian mentioned, pragmatic and meaningful, and actually sort of deliver what it needs to deliver? And I think that is sort of getting involved as early as possible and making sure it isn't difficult to deliver.
Jessica, if I could just interject there, one of the things I think is not relevant really today, but one of the things I think all developers and occupiers struggle with, and hopefully Ian will reinforce this, is the planning side. And I know we're not talking about that today, but I think most developers are actually very accomplished and are very in tune with the ESG credentials and how they're going to build it and what they're going to do and the quality of the unit. But one of the things I think they're all frustrated with is the planning process, because it does take so long. And I think it's one of the things which is holding back the supply coming forward. So I just couldn't resist saying that. So back on track, Jessica.
I mean, yeah, as talking across retail and residential as well, like I'm sure that also is a comment that, you know, many people on the residential side would touch on as well, but that's a whole other panel. So yeah, time for closing comments now. I'd say this has already gone super fast, so I'd like to come to everyone in turn. Relatively succinctly, if you could say, you know, kind of one theme, one factor that you think would define industrial logistics in 2022, kicking off with James.
I think it's all about looking ahead. Don't look to the current legislation. Don't look at so potential upcoming. The goalposts are moving all the time, so sort of design ahead and keep ahead of the trends, basically.
Thank you, Ian.
I think landlords working as close as possible with their tenants, understand their business, there's no downside to it. So that pure asset management, if you understand your tenant, your customer, you'll see what's coming, you'll be able to adjust to it and support them.
Thank you. John?
What I would say is that although there's some bad news coming down the road, I think there's still a window to actually make sure you get the 2017, the existing rateable values right, whether it's in England, Wales or Scotland. Make sure they're as low as possible. Whether you're a landlord or whether you're a tenant, just make sure that tax base is as low as possible now, and that will help you going forward.
Thank you. Andrea?
Yes, for 2022, I think the market, I'm just going to give a prediction here, we'll see in excess of 40 million square foot take up for 2022, again, driven by the growth of the online sales, even if consumer spending is really under pressure due to inflationary pressures coming from all over, from everywhere, to be honest. Still going to see strong rental growth coming through. Q4 2021, so some really strong numbers, which will continue to Q1 2022, and we're not gonna be seeing an oversupplied market by 2023.
Great, like some confident predictions there, Andrea. And Len, to finish us off and to close the discussion.
Thank you. Firstly, I would agree and echo Andrea's comments. I think it's going to be another record year. I believe it will be in excess of 50 million square feet again. I think the supply and demand dynamic, there's not enough supply coming forward. I think rents will continue to rise. I think there are one or two issues coming down the pipes, which John's spoken about and set out quite eloquently, which obviously can have an impact. Obviously, inflation is happening, but I think the logistics sector is still in very good shape. I think the e-commerce will continue to drive forwards. And then I would just like to finish off thanking you, Jessica, for moderating today. Really, really appreciate that. Of course, our panelists, James, thank you for your time today. Ian, really appreciate your new role there, taking time out of your day to come on our panel. John, as always, great to hear what's happening in the rating world, and I think food for thought for a lot of our customers and people within the industry. And Andrea, of course, for digging into the figures and where things are at. So on that note, I shall close down so we finish within the hour as always. And thank you again for taking the time to come onto our webinar today. Goodbye.